Good morning, everybody, and welcome to the Daily Energy Markets podcast. We have Brent crude oil trading a little bit down this morning. The optimism of the news out of Washington that they have decided to reopen their government, which seems sort of like a novel idea, but nonetheless, not enough to sort of lift the somewhat somber sense that this market is facing, which is a somewhat oversupply and relatively uncertain demand. Let's kick off this morning in London with Jamie Ingram, managing editor at the Middle East Economic Survey. Jamie, your thoughts on the market's general trend at the moment, the reopening of the U.S. government and all the associated activities that go with that. I mean, that's a huge amount of people going back to work. It's a huge amount of activity that's no longer being disrupted. One would have thought that's good news for economic activity and energy demand.
Hi, morning, Sean. Good to be with you. It is indeed good news for economic activity and energy demand, but I'd say that the shutdown was never reflected in pricing to a great extent, to be perfectly honest with you. I would say that it didn't cause an increase in prices to the level that people would have expected and to the extent that it would have done just a few years ago. There's so much else going on in the markets at the moment, and of course, a lot of the focus is on the issues surrounding sanctions on Russian oil producers, namely Lukoil, is in the spotlight at the moment after its deal to sell assets to Gunvor collapsed. So I think that's going to be an issue that continues to impact markets more than we're going to see the outcome of this government shutdown, or rather reopening, impacting prices.
Andy Levin, managing director at Econs, based here in Dubai. Andy, your thoughts on the general sort of malaise of the market at the moment? I mean, Jamie just mentioned a few things there that you would sense should be, at least give it that lift to the sweet spot of $65 a barrel, the US government getting back to work, but also the sanctions squeeze on the two biggest Russian oil exporters. Look like there might be some teeth in those sanctions, blocking Gunvor's ability to give them relief and at least leaving sand in the wheels there, of making it more difficult for Russia. That would be bullish for prices too. But no, there's just a sort of a wet blanket on this market. Your thoughts of the dynamics at play here?
So I think two points really. So firstly, I think Jamie's right. There's an enormous amount going on, and a lot of the noise, let's say, is contradictory. So some push it market one way, some push another. It was interesting reading one of your articles on your headlines this morning, the one about Trump's oil sweet spot. And if you look in there, there's a view of the supply-demand balance. And that kind of took me a little bit back, because the graph in that article said we've been in oversupply for quite a long time. So I went back and actually looked at the oil prices. And if you kind of stand back and look at over 2 years, the oil price has been drifting down since kind of April 24, which is kind of where we've started to get into an oversupply. So I think the bigger picture says the world is currently oversupplied. There's all this noise, so people really aren't kind of, well, are we really in oversupply? Are we not oversupply? Is demand going to pick up? All of this stuff is actually stopping, one could argue, the market cratering. Because if you look at the amount of oversupply in that graph, you kind of scratch your head and say, well, why isn't oil price down at $20? And it's because of the noise. So I think a little contradictory story is that the oil price has been drifting down ever since we got into an oversupply situation. That oversupply is not sorting itself out, but all of this noise, which may or may not increase the demand, is kind of stopping it just going down much quicker.
Malia Bengali, founder of MB Commodity Corner. Perhaps the other piece of this puzzle, Malia, is the surfacing into a sort of more concrete space, which I think you've been talking about for a while, and that is the idea that the US economy is itself generally weakening. It is the biggest oil consumer in the world. It is the biggest economy in the world. It does seem to be tangibly slowing. Job numbers look uncertain. Inflation looks like it's elevating. It's all not a very positive picture.
You're absolutely right, Sean. Also, we've seen the numbers on the, the PMI and the ISM on the manufacturing side, which is the actual demand on distillate and manufacturing. It's weak. So we've always talked about the supply excess in oil, but the demand is actually been quite tepid. And until demand picks up, we don't really see that gap of supply, being sort of fulfilled here. And I think that's why the prices are staying muted right now. If you can bet on a manufacturing recovery, then obviously oil price will do well, but we don't see that happening right now.
Looking into the direction of travel going forward, Jamie, I mean, we are already trading into the new year vis-a-vis where OPEC Plus has decided to curtail their increases. Yes, still going on through the end of this year, but ultimately the market's already moving into the first quarter. What's the difference there? That in itself, another bullish element, the idea that supply starting to be constrained by OPEC Plus, Russian oil companies being constrained, etc. Where does that play into this picture, do you think?
Thanks, Sean. Yeah, I mean, just to pick up on some of the threads that Andy was talking about earlier in particular, and yeah, we obviously have had oversupply since, about April 2024 is probably about right. But where's that oversupply been heading? A lot of it has been stockpiled by China. Famously, it's been a big talking point in recent months in particular. And if we look at inventories in kind of some of the major oil pricing points, they're still relative. They're not oversupplied at the moment. Those inventories are relatively low by historical measures. So that's certainly one of the things that has put a floor under prices, I would say. If we look at what we're going to see in the near future now, of course, in relation to your question, we are starting to see oil flowing into some of those traditional pricing points. There is a lot, the amount of oversupply on the market is increasing now as we head into the seasonal weak spot for global demand. So that's probably going to continue that drift downwards in terms of pricing for the next few months. Are we going to test the kind of the floor of $60 again for Brent? Quite possibly. The question is, how long does that persist for? As you say, there's a lot of pushing and pulling in both directions on the markets at the moment. You point to supply issues, the issue of Ukrainian strikes on Russian refineries, that kind of thing. That's a key issue that flares up in the markets again. Is the US really going to have more teeth on these sanctions on Russian oil? Are we going to see secondary sanctions imposed on elements of the financial market that persist with dealing with Lukoil and Rosneft? Are we going to see the US start to impose more sanctions on more Russian companies and potentially on the buyers themselves? These are some of the things that could really start to have an impact on supply and in the coming months ahead. As it is, we're on a course towards gradually lower prices over the next 6 months, most likely. But I would say that the US sanctions policy on Russia is one of the key blind spots that we have that could change that direction of travel.
Andy, the general narrative all year has been very much, there is a cliff edge coming, and with the sort of ample supply, there's been a general bearish tone that China macro weakness sort of dominated the narrative through the year, and there's sort of expectation, and you even felt it at ADIPEC this year. A number of senior officials took the opportunity to slap the market back. All these sort of branding it as these negatives, these naysayers, these sort of doomsday predictions. Ultimately, people are making the forecast as they see it. Have we got it very wrong this year? I mean, where do you see that sort of narrative that has not yet delivered and may still do so into the new year, but that sort of juxtaposition of getting it wrong?
I don't think there's an element. Well, maybe put it this way: saying we're getting it wrong is probably far too simplistic. I think the market has been very comfortable with scenarios where, in general, there's a balance. So if the supply outstrips demand, then the prices go down. If it goes the other way, then prices go up. And that's the same thing when you look at stocks. People used to really focus on stocks in the
As
US
in inventories.
Exactly, right. Whereas and that was what was, in a sense, was shocking about that graph, where you look at the gap between supply and demand. I mean, Jenny's right. Yes, there is some that can go into storage, but it's like there is a really big gap here. And why hasn't the market really come off hard? And I think it is because of the two things. One is we're not used to a market where there is such a surplus of supply. And it's almost like, but there can't be that amount of supply, because if there was, then there'd be oil everywhere, and there isn't. So there's some question about whether that supply number really is correct. And then on the other hand, there's this enormous amount of lack of clarity as to what is happening geopolitically and how that impacts the demand side of things. You kind of look at US, you pull together what both Jamie and Maliha were saying. You look at the US and you go, well, is it going to get better? Is it going to get worse? Is Trump's policies working, or are they not working? Is inflation going up? Is inflation going down? Is the market weak? I have no idea. And part of the reason I don't have any idea is because, you know what? Tomorrow he may say something different. And therefore, the market is kind of going, I don't know what to believe.
Maliha, in that sense of directionless, I mean, we do have obviously a lot of big players have to make decisions, including the Fed, and where is inflation in all of this, and where is the direction of the price of money? There was a sort of a built-in expectation, pretty solidly so, that the Fed was going to be in a continuous cutting framework cycle, but the Fed chairman was quite particular in pronouncing at the last meeting that not to bake in that December was going to be another cut. Where do you think monetary policy makers are at the moment, and where are they being guided? What are they being guided by? I know they've struggled between their sort of jobs mandate and their inflation mandate. No, Maliha is speaking under
I'm so sorry, that was
red
muted.
microphone.
I think going to the December cut, the market priced in about a 90% chance of a rate cut. But into the meeting, the Fed Powell, he sort of hedged himself, leaving the door open. The market took it quite negatively, but I think the door is still open in terms of a cut. They need to see more labor market data. And the numbers we've seen from the challenger market, the ADPs are coming a lot weaker. We are in a shutdown, so they don't have clarity as to the exact numbers, but the estimated numbers are quite, low. So I think the labor market is showing real signs of softness. They could still cut, but there was a bit of a hawkish cut back in November, and the market got a bit spooked. But it doesn't really change anything, because I think their focus still is much more on the labor side than inflation. I mean, they're talking about basically increasing reserves in December, which is sort of increasing the balance sheet and ending QT. So this is mildly dovish in terms of they're looking to support the markets again. And that's what the Fed does.
Where do you think there is at this moment? I mean, speaking to Andy's sort of directionless market, what is getting the greater weighting at the moment? Clearly, inflation was the biggest gorilla in the room for a number of years as we went up to 9-10% and came down again. But since we've got around to 3, the sort of focus and Trump's return to power is back to the job markets, which is sort of gives a gateway for further cuts. If you were just looking at CPI and inflation, you might be very hesitant in the history of time to be cutting rates at 3%. But they seem to be juggling between the two. Where do you think they're primarily focused at the moment?
The focus, Sean, is definitely on the labor side of the market. I mean, inflation at 3.1%, they should not be cutting rates. We know the Fed made a mistake last year and they're still doing it right now because they're focusing on the wrong things. And right now, more importantly, they're also talking about increasing funding and banking reserves because of the SOFR crisis. The repo market was in shambles 2 weeks ago. There was a bit of a stress in the system. Every time the bank reserves fall below a certain level, there's a bit of a funding stress. It's very technical on the macro side, but that just means the Fed can't tighten the balance sheet too much. The system is too big to fail. It's too much debt. And every time they're trying to use a reason to cut rates. So we think they're going to be cutting rates for the wrong reasons, which is going to fuel inflation even higher. And I think that is a big mistake. But the Fed has no choice because it's looking at the data. They need to make sure that employment stays robust. So the mandate is at the cost of inflation.
Jamie, just looking at the top sort of stories in your Mies publication last week, I was just taken by the fact that both were the data-driven. They were both looking at capacity increase, Aramco elevating its gas target. And then the other headline you had, ADNOC on course for its 5 million barrel a day target by 2030. I thought personally that was going to happen earlier than that. You have capacity currently in the UAE at 4.85 million barrels a day. The reason I just want to bring in this topic is because I wanted to get your thoughts on why OPEC Plus are sort of abandoning further increases from January. How much of it is market management and how much is it internal OPEC Plus management? Because ultimately nobody can really increase anymore. And of the 2.5+ million barrels of quota increases this year, a lot of reporting is indicating that maybe at best half of that was physical barrels on the market. So I wanted just to get your view. Where's Mies at in its reporting on that this sort of stop in increases is due to the fact to manage internal dynamics because very few can actually increase supply. Your thoughts on that thesis?
Thanks, Sean. There's definitely a lot going on managing the internal and the external forces, as you rightly note. I would say that in terms, when we look at what OPEC Plus has been doing in terms of managing the internal issues, frankly, that strategy led to the accelerated increases in quotas. It was all about showcasing who is already in breach of their quotas and bringing those quotas somewhat in line with where they're producing at the moment and highlighting who is unable to continue increasing. They want to show to the market.
Have they got that clarity, do you think, now?
They've got a bit more clarity.
The tide's out, who's got clothes, who doesn't, is clear?
There's still a couple of people swimming in the shallows at the moment, I think. Right. I think there's definitely scope for once we get out of this Q1 spot, which people within OPEC Plus have been saying for quite a while now. That's when they see the real issue of oversupply. They weren't too concerned about the current quarter. It was always Q1 that they had at the back of their minds. So I suspect that from conversations I've had, that we will see them start to increase those quotas again from April onwards. And that's the issue that is less about market management and more about internal management as they head into they start preparing everything for the next phase of the OPEC Plus mission, which will be 2027 onwards. They want to prepare the ground for that by assessing who actually has the ability to produce and who doesn't have the ability to produce in line with what they're saying at the moment. So for me, the Q1 pause, that's about external forces. That's about saying this is an oversupplied market. This is when demand is soft. And yes, everybody, you are correct that we are not producing. The production quota increases do not translate into anything like the same scale of actual barrel increases that we tell you that they do. But even despite that, we're still going to be taking it soft, taking it cautious for Q1.
Andy, I wanted to get your thoughts on the sort of debacle that is the Lukoil International assets that Gunvor a week ago in the middle of the ADIPEC week became the sort of declared buyer of those assets, despite the sort of funky numbers, 22 billion, and they're only worth 6 billion. How is that possible? Anyway, by the end of the week, that had all fallen apart because the US government had essentially said they wouldn't approve it. Yet the oil market doesn't seem to be too stressed, even though we're days away from the implementation of the sanctions that make Lukoil untouchable from a sort of international Western point of view. How do you see this playing out?
So I think that the West has always struggled to find out how to create sanctions that make a difference. And I don't see any real difference with what's happening now and the latest US sanctions in history. The market is going
impotent sanctions? They're just another bunch.
Impotence not quite the right phrase. It just doesn't make a difference for everybody. It worked when the US realized, which they knew but never did, that actually if you intervene and say, from a banking perspective, there's an issue. Well, that suddenly works because every US transaction goes through a US bank. So that suddenly works. But just basically saying, no, this company is US sanctioned. Well, okay, that means that anybody in the West isn't going to be interested. It doesn't mean that they're going to stop. It doesn't mean that somebody in the East isn't going to be interested. It just makes it a bit more difficult. And you've seen, history tells us, Iran has always been able to continue to export and sell products despite years of sanctions. You can see China is still buying Iranian barrels, is still buying Russian barrels. So yes, at the edges, you can make a difference. If you want to intervene in somewhere like India and make it far more difficult by
but these are refineries sitting in Europe, in the European Union and other Eastern European countries. These are, refineries in which a number of countries in the middle of Europe depend exclusively upon. It's not. I suppose there's the examples you mentioned. You might say, well, there's reasons why they've been able to get around it, but in the center of Europe, it seems a bit more problematic.
Yes, but and this is where you kind of come with this whipsaw Trump kind of situation. He was telling Europe, you have to stop buying Russian products, and then he gives Hungary a year's grace, right? So somebody comes along and says, we need this refinery. We've got to get this sorted out. It's going to take. Okay, fine, have 6 months. Until there's something real. It's just rumor, okay? And yes, it looks real, but it hasn't actually changed anything yet. And there's a lot of off-ramps that are possible in terms of how you could structure it differently. It's just going to be, what do you give Trump in exchange, unfortunately?
Let's go to the survey question on the sort of thesis of the news of the day. The end of the US government shutdown, not sufficient to lift wet blanket weight of weak demand and oversupply off this market. Agree or disagree? That is the optimism or the positiveness, if you like, not sufficient. Malia, just looking to Asia and where all of this plays out, we get quite focused and anchored. Obviously, America, big demand center. Europe, it's G7, but somewhat tepid. Asia, China remains the sort of key pillar of the international oil markets, and Asia in general. Your thoughts on how this current period, if we start our conversation, this uncertain direction. But weaker dollar, good for Asia. Lower interest rates, good for Asia. What's your read on the emerging markets of Asia?
Well, as the dollar falls down and we get interest rate cuts, that'll be obviously positive for emerging markets. We've seen the markets rally quite a bit. But from a demand point of view, I think there's been a secular change, shift in Chinese demand and onshoring of inventories. They have a lot of storage now. So I think there's a bit of a demand shift. China's become a lot more price sensitive. They've been managing their inventories quite well. So the demand lift will not impact prices as much as it did before in the past. I think that's the biggest change in Chinese demand. We've seen the demand numbers change drastically over the last few years. But net, I think the demand has been, like you said, has been tepid until we see a massive shift in the overall global economic cycle. We don't see a big, needle sort of moving the price metrics. It's going to take a lot.
I mean, in the middle of all of that, we've had the obviously this 6 months of trade war that seems to have kind of moved off center stage, but is still present. I mean, the feed through of that is still, we're seeing it in prices in the US, inflation starting to bleed through. But in Asia, the drama's over. What's your sense?
Well, yes and no. There's a lot of delaying tactics. All these deals being happening. I think China's, pretty much pushing it out for 2 or 3 years. They're trying to agree on rare exports. There's so much noise, Sean. It's really hard to tell right now. I mean, Trump, right now we're going to see the Trumps are going to be effective, the tariffs right now. So I don't think that changes the pictures. Things are still flowing. The global supply chain alliances are changing. I think both parties know that they may have an agreement right now on some deals, but they have to diversify their supply chains in the future. So I think the big thing right now in the market, the focus is the dollar. Interest rate policy, Federal Reserves, QE or not QE. I think those things are going to be very, very important for risk assets and inflation assets going forward, which I think oil could benefit from if there's a massive surge in liquidity.
Jamie, I mean, looking into the sort of beyond the immediate window, but ultimately into this oversupply narrative, the question on where does the non-OPEC plus countries come into play? We've seen in recent years big surges in Guyana and elsewhere, but U.S. shale generally, again, amongst the long list of uncertain questions, will shale go back to growth and somehow climb beyond, give the American oil production a lift beyond the sort of 13 plus, kind of get back up above that. Your thoughts on where the non-OPEC supply goes into the sort of new year narrative of oversupply or not?
Thanks, Sean. Yeah, US. I would say there is a clear consensus now that we're not going to see levels of significant growth coming out of that patch anymore. It's all about moving from tier 1 to tier 2, maintaining a very long plateau at these kind of levels. Nobody's talking about US production dropping off or anything like that. But the days, much like the days of China driving the demand side of the equation, the days of the US shale driving the non-OPEC supply side of the equation appear to be in the rearview mirror now.
And beyond that, I mean, there is increasing reporting that, with Argentina getting its act together, there could be supplies coming out of there. Venezuela, if indeed this political system does end up ending and something else comes in its place, a wave of new supply from there, given its reserve capabilities.
It's possible. Venezuela will take quite a long time to get back to its former glory years. The system there needs a lot of work. It's not the easiest of oil reserves to develop as well. Of course, a lot of those reserves are very heavy oil production. I would say that a lot of these potential sources of new supply, that's what you need to develop in order to offset declines elsewhere. Natural decline rates running at 5-6%, something like that globally. You need a lot of new oil developments being brought online just to stay flat. So that's what you're looking at from the likes of Argentina.
And on that, Andy, I mean, the point I was going to come to you was, where are the IOCs at the moment in all of this list of uncertainties? We saw Shell announcing plans to abandon some renewable assets. The IOC's willingness to put money in the ground?
I think there has to be a significant amount of uncertainty within the IOCs as to where the oil price in the medium term is going to be, which is what they need for kind of financial sanction. I think you very much see that in the general kind of drift away from renewables, where they don't have an enormous amount of understanding of the future, and their confidence and experience is all in the oil. but then all of that oil comes down to what's it cost to get it out of the ground and how much can I sell it for. So it really comes down to basic fundamentals of economy, supply and demand, and oil price. And today, in a weakening market, it's difficult to see how anybody is going to be really bullish in terms of long-term, highly expensive exploration and production. At the margins where they've already spent a lot of money, yes. But if it's gas, yes. But oil, and predominantly oil, it's a challenge, I think.
Malia, last word to you in trying to tie these markets together. I mean, we're seeing the financial markets continue, the equity markets continue to hit records. They have these moments of blip, and there's clearly some nervousness around and maybe profit taking. But from a financial markets point of view, do you think this is still a risk on market? I mean, we've seen Bitcoin give up a lot, which is sort of a flagship for risk on appetite. Your thoughts on where that goes, and then with it, where does gold go? Because gold has kind of given up a bit of its sort of optimism, well, not as optimism, it's pessimism about the outlook for inflation, and has pulled back a bit. But where are the financial markets going, and what do they tell us about the rest of it?
I think the equity markets right now, the numbers have come out quite good on the Q3 side. I think the sell side analysts had about plus 7% EPS growth. They've come in at plus 14%. So the numbers are holding up on the index from the equity side, but they're sort of flatlining. There's a pockets of strength. The 7 or 8 names are doing really well. The large cap techs, the bottoms not so much. On the gold side, we've always loved gold. Yesterday, Trump was talking about how they're going to hand out $2,000 stymie checks from the tariff revenue or dividend revenue. Where's this money going to come from? There's more and more money being printed, which is why gold and silver keep rallying. Hard assets, inflation, the Fed and the economy, they have no choice but to print more, cut more rates, and eventually fiat currency debasement. So gold is going to keep going higher. It's the ultimate hard asset inflation hedge, effectively. So that's why it's running what it is. There's just more money need in the economy.
And it's hard to see. I mean, if there's one thing that sort of, when there is no other answer, it seems to me that in terms of what keeps the market propped, and oil included in some ways, even though it's not enjoying the elevated heights of equities, but liquidity, liquidity, liquidity. It's an ocean of it. It's been there for a decade, and it keeps everything propped up to, I mean, in some ways, $65 Brent is kind of like the old $10 oil or $20 oil. It's just sort of the baseline of, with that scale of liquidity, it seems to me, when there's no other reason immediately available, I say, look at liquidity. Listen, thank you so much. It's great to get you three guys on. Jamie Ingram in London, of course, up early this morning. We appreciate that, as well as Malia, that both of them in London. And thank you for doing that and getting with us. Andrew Lavin, of course, here in Dubai. Myself enjoying the 10:30 a.m. very comfortable time zone. We do appreciate your flexibility of getting up early and bringing your thoughts. All the best, everybody. We'll catch up with you soon again. Thank you.
Thank you, everyone.
Bye.